Nancy, am I audible?
Yes, ma'am. Good evening, ma'am.
Good evening, good evening. Okay, so today we will be studying funds flow statement. See, whenever we are talking about a funds flow statement, first of all, do understand that it is a statement which is going to give you the information regarding the sources from which funds are obtained and the application of those funds, right? That means from what all sources we were able to generate funds and in what all applications we used it to pay off. And in this case, when we are talking about funds flow statement, that means the concept of funds is revolving around our working capital. When I use the term working capital, that means I'm talking about the capital that is required for day-to-day operations, right? So in this case, whenever we are talking about funds, let's just try to understand what do we mean by flow of funds. See, when we are talking about flow of funds, it means that there is a change in the form in which funds are there in the business, right? Or we can say it, when I'm using the term change of funds, that means I'm talking about change of working capital. As I told you, funds in this case refers to working capital, right? So that means in this case, there will be an increase or decrease in the working capital, or we can say flow of funds. So if we talk about the funds flow statement, see, there are two terms which are, you can say, uh, closely related to each other. One is known as funds flow statement and the other one is known as cash flow statement. So if I talk about the funds, that means I'm talking about a broad concept. Whereas in case of cash flow statement, that means we are talking about one component of the overall funds. So funds means all types of components of funds, and cash flow means just one component of the funds. So we can say in a narrow sense, if I talk about the funds flow statement, then it is prepared only for cash, and that is known by the name of cash flow statement, in which we study only the inflow and outflow of cash. And when I'm saying cash, cash is just one component of the funds flow statement, right? But in a broader sense, when I talk about the term funds, then these funds refer to the money value in whatever form it may exist. That means in this case, I'm not just considering cash, but I'm considering funds in whatever way it is existing in the business. And that could be either in the form of men, material, money, machinery, methods, etc. Right? So in the popular sense, we can say the term funds means working capital, which is excess of current assets over current liabilities. See, the concept of working capital we'll be doing in detail in the later chapters. But as of now, this working capital is nothing but the capital required for day-to-day operations. And when we are studying working capital over here, that means we are studying the net working capital. See, we have two types of working capital. One is known as the gross working capital. The other one is known as the net working capital. But whenever we are talking about, taking any decision or analyzing something, then net working capital is the concept that we use. And net working capital is total current assets minus the total current liabilities. So in general, we say net working capital is equal to current assets minus current liabilities, right? Now, as I told you that in case of working capital, you have two options, gross working capital and net working capital. Net working capital I've already explained. And if I talk about gross working capital, it refers to the total amount of current assets in the business. So that means here we are just considering one component, that is current assets, whereas in case of net working capital, we take both the concepts, that is current assets and current liabilities, into consideration. So as a result, we say net working capital is more useful and is more correct way of analyzing the things, because whatever funds you generate from your current assets, they are used to pay off your current liabilities, right? So after paying your current liabilities, if anything extra is left out, that is termed as net working capital. Now, whenever I'm talking about your funds, you know that your funds, they keep on coming and going. It's not that if I have a particular amount in business, so that is always there with me in the form of cash. No, that particular amount keeps on changing its form. That means I may receive the amount, I may have to pay it in some way or the other for some or the other services or some or the other expense or something, right? So whenever we are talking about funds in this case, it means that change is taking place in funds during a certain period, right? And whenever there is a change, it is presumed that flow of funds has taken place. Transactions, they keep on bringing working capital into the firm, and those transactions which keep on bringing working capital, they are termed as sources of funds. And on the other hand, those transactions which involve paying the funds, they are termed as application of funds. Now the question arises, Okay, so we were discussing about the objectives. Now, see, whenever we are talking about the objectives of funds flow statement, do remember that these such a statement of funds flow statement, it will help you in pinpointing the mobilization of resources and the further utilization of resources. Because until and unless we know about the sources and application, we will not be able to plan for the upcoming future, right? And until and unless we know that from what all resources we can generate funds and in what all sources we need to pay them off, so we will not be able to move ahead. Secondly, it will highlight the financing of the general expansion of the business firms. What happens is, because whenever we are thinking about, expanding our business, then we need finance for that. And when you have to plan for the finance, you just cannot expect that randomly on the spot you will be generating finance. So for that matter, a proper planning is required, and for that planning, we need to prepare the funds flow statement. Also, it exemplifies the utilization of debt finance in the structure of financing. Whenever we have to finance or whenever we are in need of money, we have two sources. One is the equity and the other one is debt. When I use the term equity, equity means our own capital or what we call as owner's capital, right? But when we talk about debt, then debt means we are talking about borrowed capital, right? So you have to see to it whether you want to go for equity or you have to go for finance. Because, just a minute. So whenever we have to raise funds through equity or debt, it is not just as per our choice. No doubt, we have to see our choice, but at the same time, we also have to see that what all is possible. If I want to go for equity, say for example, I want to invest my own money, but I do not have that much. So I'll have to move on to debt, right? So I'll have to see that what all options are available, whether I can go for it or not. So pros and cons of each and every option is to be studied. And also it will establish a relationship between the financing, investment, liquidity, and dividend decisions of the firm during the given point of time. Because whenever we have to, arrange the funds, that means, as I told you, that you have to arrange the finance. Then once you arrange the finance, then you have to see that where to invest and where not to invest, because you might be having 3 different projects. So you will have to take a decision in which you want to make an investment. Then out of the given investment, which will give me money at what point of time? Because there might be a possibility that in one project I invest today and I will get the return after, say, for example, 5 years. So do I have the sufficient capacity to wait for another 5 years, or I'll have to think about something else? Or there might be a possibility the other project is saying that you invest the money today and you will start getting the returns after 6 months. So you will have to see in which you want to make an investment. And whosoever is investing their money in the project, you have to pay them dividend also. So what are the terms and conditions of those dividend payment? So accordingly, you have to consider each and everything. Now, the question arises, what exactly are the advantages of preparing this funds flow statement? See, whenever we are preparing a funds flow statement, first of all, it is giving us information about the fund generating capacity of the organization, right? Because until and unless we are able to generate sufficient amount of funds, we will not be able to move ahead in the business. Secondly, it helps us in knowing the changes in the working capital position, because working capital is the capital required for day-to-day operations, and it is that part of the capital which is very, very important. Reason being because the day-to-day operations are the core activities of the business. Thirdly, it also helps in preparing the projected funds flow statement. See, normally what we do is we prepare the funds flow statement from the previous year data. But with the help of that previous year data, we can further prepare a projected funds flow statement also, which will tell us about the situation of the organization in the upcoming year. It will also highlight the causes of changes. That means whatever changes have happened, what is the reason behind it, right? So that you can make an analysis of those situations. Also, it will evaluate the creditworthiness, because in the present day situation, every organization needs to get its creditworthiness done, because if you are not creditworthy, then nobody will be giving you the credit. Credit means nobody is going to give you material on credit. Nobody is going to deal with you on credit. That means nobody is going to provide you funds also. Because whenever anyone is providing you the funds, that means they are giving their money to you for a considerable amount of time, right? And if you are not able to return that money, then certainly they are the ones who are going to suffer the loss. So as a result, if the concerned organization is not credit worthy, so nobody would like to trust them and nobody would like to deal with them. Next is it highlights the causes of the following contradictions. First is adequate cash reserve but insufficient profit. See, many times what happens is that your organization is showing a good amount of cash availability, right? So in general, we think that if I have a good amount of cash available with me, so then it means the organization is in a very good position. No, it is not always true, because there might be a possibility that no matter you have good amount of cash available with you, but still the overall profits are insufficient in the organization. Secondly, there might be another possibility that you might have sufficient profits in your organization, but you have inadequate cash reserves. Why? Because you might be giving more credit to your customers, or maybe you're not efficient enough to collect your funds from your debtors, and there can be various other things. So that means no matter that you are able to earn good amount of profits, but you're not able to maintain a sufficient amount of cash reserves. So in both these situations, your funds flow statement will also highlight the reason why these two situations are prevailing in the organization. Because in both these situations, no matter that your organization is a running concern, but still you will be facing problems, right? Now, when we are talking about the advantages of funds flow statement, at the same time, we have certain limitations also. No matter your funds flow statement is telling you about the changes in the overall funds, but it will not present a continuous change of financial activities, including the working capital changes. So it will just give you the overall change, but not the continuous changes that are happening, because it considers the data between two different dates. That means they study that, okay, previously it was this much, today it is this much. So between the two dates, the overall impact of change is this much. They do not study the continuous changes that are happening in the financial activities of the business. Secondly, since it is based on the financial statement, because we use the data for your funds flow statement from your income statement, that is P&L account and balance sheet, right? So it is not an original statement, right? Thirdly, whenever we are preparing a projected funds flow statement, then it is not a very accurate statement. Reason being, you are projecting the future, right? And if you are predicting the future, it is not necessary that that future, whatever you are predicting, is going to be 100% correct, right? So there can be errors in that. And if there are errors, then certainly it will be a problem for you, right? Fourthly, we say that it is not a substitute of financial statements. When I'm using the term financial statements, that means I'm talking about the income statement and the balance sheet, right? Now, when I'm using these two terms of income statement and balance sheet, That means even if I am preparing a funds flow statement, it does not mean that I need not prepare my income statement and balance sheet, because funds flow statement is giving me information about the sources and application of funds. It is not giving me information about the financial position of the business, or it is not giving me information about the net profit earned by the business. So as a result, no matter I'm preparing the funds flow statement, but still I have to prepare the financial statements also. Then usually it is considered that with respect to your funds flow statement, cash flow statement is more important. Reason being because cash flow statement is short term in nature and it gives you more precise information as compared to your funds flow statement. Right. Now, whenever we are talking about the funds flow statement, there are different types of transactions which will result into inflow or outflow of funds. Right. So let's just try to understand. If we have transactions affecting current accounts only, current account means I'm talking about short-term accounts, or you can say short-term assets and liabilities, right? Now, do remember whenever current accounts are involved, it will not result in flow of funds. Why? Because whenever I'm using the current accounts, because these accounts, they are going to produce changes in the working capital account, but they do not change the amount of working capital, right? Second is transactions affecting the non-current accounts only. They also do not result in flow of funds. Say, for example, if I'm talking about that you are charging depreciation on, say, for example, on machinery, right? So if you are charging depreciation on machinery, so that means neither anything is to be paid nor anything is to be received. It is just reducing the value of your machinery in your accounts, but nothing is going out, nothing you are going to receive. So as such, it is not resulting in any inflow of funds. Third is the transactions affecting non-current account and current account. Such transactions will result in flow of funds, either as a source or as an application, right? So in this case, you can take an example. Say, for example, I say that we have purchased a machinery. If we have purchased a machinery, so what will happen? That means I am using funds to pay for the machinery. And if I'm using funds to pay for the machinery, so that means my funds are going out. So that will result in outflow of, or you can say application of funds, right? But if I talk about that, okay, I am receiving funds. Say, for example, I'm selling my old machinery. So if I'm selling my old machinery, so in that case, what will happen? In that case, I will be receiving some amount. So that will result in inflow of funds, right? So that means we have two concepts. One is the sources and the other one is the application of funds. If I talk about the sources, I can talk about funds from operation, sale of fixed assets, issue of shares. And on the application side, we have purchase of fixed assets, purchase of investment, increase in working capital. So that means all those transactions in which we pay the amount, that is the application, and all those transactions in which we receive the amount, that is known as sources of funds. Now, whenever I'm talking about funds flow statement, it involves three main steps: statement or schedule of changes in working capital. Second step is calculation of your funds from operation. And third is the statement of sources and uses of funds, right? Starting with the first statement, that is statement of changes in working capital. See, as I told you, working capital is related to current assets and current liabilities, which are the two main components of your working capital, right? So we need to study what will happen in this case. In this case, do remember that there are certain rules related to the preparation of the statement of changes in working capital. Increase in current asset results in increase in working capital. Decrease in current assets results in decrease in working capital. That means current assets and working capital, they move in the same direction. Increase in current asset, increase in working capital, decrease in current asset, decrease in working capital. And if I talk about the current liability, increase in current liability will result in decrease in working capital, and decrease in current liability results in increase in working capital. Now the question arises, I have just given you the rules, how to understand or how to remember that these rules will happen, right? I'll just show you how you can use it and how you can understand it. Just give me a minute. Now, I'm just taking some certain hypothetical figures. If suppose my current assets, I hope whatever I'm writing is visible to you all.
Yes, ma'am.
Okay. If my current assets are 10,000, right? My current liabilities are, say, 6,000. So I can say that my working capital is equal to current assets minus current liabilities, which is 10,000 minus 6,000. I can say my working capital is 4,000 in the given situation. Now, if I increase my current assets to, say, for example, 12,000, current liabilities remains the same, 6,000. So my working capital will be 12,000 minus 6,000, that is 6,000, right? So in this case, I can say, I can frame a rule that increase in current asset means it will lead to increase in working capital, right? Now, if I reverse the situation, I say that my current assets decreases from 10 to 8. Okay, sorry. Just a minute. My current liabilities remains the same, that is 6,000. So my working capital will be 8,000 minus 6,000, that is 2,000, right? So I can further say, with the decrease in current asset, my working capital also decreases. So that means they are moving in the same direction. Now I move ahead with current liabilities. That means I'll bring a change in the current liabilities, right? Now, my current assets are 10,000. I say I want to make a change in the current liabilities. From 6,000, I want to increase my current liabilities to 8,000. So that means my working capital is 2,000. And similarly, if I change the scenario, that means my current assets are still 10,000. My current liabilities decreases from 6 to 4. So that means my working capital is 6,000. So I can again frame the rules that with increase in current liabilities, here I had increased the current liabilities. So that was decreasing my working capital. And if I am decreasing the current liability, then it will increase my working capital. right? So what I can say is that current assets and working capital, they move in the same direction, or we can say there's a positive relation. But if I talk about current liabilities and working capital, then they move in the opposite direction, or we can say they have a negative relation, right? So these are the rules that I was showing to you on these slides. And this is how we study these relationships, right? Increase in current asset, increase in working capital, decrease in current asset, decrease in working capital, increase in current liability, decrease in working capital, and decrease in current liability, increase in working capital. This is the format when you prepare a statement or schedule in the changes of working capital. I'll write down all the current assets, right? Then I'll write the figures, because I told you that whenever we are preparing the funds flow statement, it is between two dates. So previous year and current year. And then we see if it is increasing the working capital, we'll write it in the increase column. If it is decreasing the working capital, then we'll write it in the decrease column. Similar act we will follow for the current liabilities, and then we will calculate the change in working capital, right? Now, after moving ahead, that was the first step of calculating your funds flow statement. The second step is when you need to calculate your funds from operation. To calculate your funds from operation, you have two options. Either you can prepare a statement like I have prepared it here, or you can present it in a form of an account. I'll show you both the methods. Then it is your choice how you want to proceed. Now, when I'm talking about a net profit, to this net profit, what you need to do is you need to add all the non-fund, or you can say non-cash and non-operating items which have been debited in P&L account. And what all do we debit in P&L account? We debit all the expenses and losses. So you have to see which is, now when I'm using the term non-fund, just take the example of depreciation. When I'm saying depreciation, that means in case of depreciation, I'm neither paying anything nor receiving anything, right? So as a result, in case of depreciation, we consider it as a non-cash expense. In case of depreciation, no matter it is an expense for the organization which is shown in your P&L account, and there is nothing wrong in that, but still if we consider it, then we say that it is a non-cash expense. Why? Because nothing is paid for it. It is just shown in your books of accounts, right? Similarly, if I talk about goodwill written off, as I told you that whenever we are talking about goodwill, in this case, excuse me, we pay for goodwill in 1 year if we have purchased something, right? But that whatever we have paid is going to continue in our books of accounts for the lifetime of the company, right? And if it is going to continue in the books of accounts for the lifetime of the company, so that means it is of no use. So what do? We just consider that for how many years or for how much time this goodwill is going to give us the benefit. And whatever is the benefit, that is divided into number of years, right? And then we write it off in the subsequent years. And when we write it off, so that means we are again showing it as an expense, but practically we are not paying anything in the subsequent years, right? So as a result, it is also considered as non-cash expense. Right? Similarly, you have discount on issue of debentures. Whenever we are talking about discount on issue of debentures is a discount that you give to your investors at the time of issuing the debentures. So at that point of time, whatever is the discount, but still you are receiving some money. And if you are receiving some money, then how can we show it as a loss? But still we show that discount in the form of a loss. So in this case, all such non-operating and non-cash transactions are to be added over here. In a similar way, you have certain non-cash and non-operating items which were credited to P&L. That means they are either incomes or they are either gains. Because if you remember the last class, in last class we had studied the debit and credit of the P&L account, right? So here we are talking about those things only. So you have to see here I have written loss on sale of fixed assets. If loss on sale of fixed asset is added over here, then profit on sale of fixed asset is shown over here. That means in less component. Similarly, profit on revaluation of assets is also done. Then rent received, dividend received. These items are non-operating income. When I use the term non-operating, what does it mean? That means they are not related to the core activity of the business, because whatever you receive from the core activity or whatever is the transaction related to the main activity of the business, that is known as your operating items. But when I'm talking about, say for example, I was having an extra building, so I've given it on rent. So that means no doubt I'll be receiving rent on that, and that will increase my overall earnings in the business, but that is not the operating activity of the business. So as such, we will show it over here. But the same thing, I can show it in the form of profit and loss adjustment account. So you can see that I will, all the items which were to be added, I have shown over here, and all the items which were to be subtracted, I have shown over here. And based on these two, I'll calculate my balancing figure. That is, if this side is short, then it is funds from operation, and if this side is short, then this is funds lost in operation. See, whenever we are calculating the balancing figure, we see that which side is short. That means which side is less. Short means short by how much amount, right? So based on that, we will be calculating the balancing figure. And if this side is short, we call it as funds from operation. If this side is short, then we call it as funds lost in operation. That means out of the given two sides, one will have more balance and the other one will be having less balance. So accordingly, we will be calculating the balancing figure. And finally, we will be calculating the third, that is funds flow statement, the third step for your FFS, that is funds flow statement. Again, in this case, you have two ways of presenting it. You can either present it in a statement form, or that means in the vertical form, or you can present it in a T form, like we prepare an account, right? But do remember that whenever we are preparing the funds flow statement, now see, if you remember current assets and current liabilities, we have studied under the schedule of changes in working capital, right? So here we are talking about all the non-current components, right? So if there is an increase in fixed asset, that will result in application of funds. Now the question arises, how come increase in fixed asset will result in application? Now let's see. Now just have a look. If suppose I purchase machinery for rupees 1 lakh, so that means my machinery is increasing with rupees 1 lakh. At the same time, I have to pay cash, so my cash is decreasing with 1 lakh. So this results in outflow, or what we call as application of funds. So we can say increase in fixed asset will result in outflow of fund. Now, if I say sale of old machinery, rupees 10,000. In this case, my machinery is being reduced by rupees, sorry, it is 10,000. By rupees 10,000. At the same time, my cash is increasing by rupees 10,000. When I'm using the term cash over here, I'm basically talking about funds over here, because cash will be studying in the next one, right? So in this case, this will result in inflow of funds, or what we call as sources of funds, right? If I talk about issue of shares, if I'm issuing shares, so that means my share capital is increasing. At the same time, my funds are also increasing because people are investing more money. So as a result, this will act as source of funds for the organization. Suppose I say I want to repay the loan. If I'm repaying the loan, then in that case, no matter my loan is reducing, but at the same time, my funds are also being reduced. So this is known as application of funds, right? So this is how we study the funds flow statement, right? Now, let us try to understand it with the help of a numerical. So these are the different sources. I've given the examples of different sources and applications. Along with the questions, it will be more clear. And this is how you can present it. You can either prepare it this way, this one, or you can prepare it this one. This is in a statement form, and this is in an account form, right? And in account form, this side is sources, this side is application, and both the sides should be equal, right? In this statement form, we start with the sources, write down all the sources, we write down all the applications and do the total, right? Now, this is one question given to you. From the following information, prepare a schedule of changes in working capital and a funds flow statement. A balance sheet is given to you for 2 years. That is 31st March 2018 and 31st March 2019. These are the liabilities and these are your assets. Capital, profit and loss appropriation account. That means it is actually telling you about the profit and loss account, and you have earned profit over here. Then you have bank loan, bills payable, sundry creditors, and reserve for taxation. Similarly, on the asset side, you have goodwill, land and building, plant and machinery, furniture and fittings, stock, sundry debtors, BR, bank, and cash. Now, I start with the first step, that is schedule of changes in working capital. Right? In this schedule, I'll write down all the current assets. I'll show you the balance sheet again. Out of these, let's see which are the current assets. Current assets means short-term assets. That will be this inventory, sundry debtors, BR, bank, and cash. And from the liability side, it will be bills payable, sundry creditors, and reserve for taxation, right? So I've just listed down all of them over here, and I've written the figures over here, previous year, current year. Then I'll see which will lead to increase in working capital and which item will lead to decrease in working capital, right? Now, in this case, if you remember the rules, we say that increase in current asset leads to increase in working capital and decrease leads to decrease in working capital. In case of stock, my current year figure is decreasing. So as a result, my working capital is also decreasing by 1,02,000. So I've shown it over here. Similarly, my sundry debtors, they have increased from 12 lakh to 12 lakh 80,000. So I've shown it in the increase column. BR, that is bills receivable, they have also decreased. So in the decrease column, bank has decreased. In the decrease column, cash has increased. So in the increase column. Now moving ahead with the liabilities, bills payable have increased. But for liabilities, we know that the rule is opposite. See, do remember that whatever may be the situation, the rule for assets and liabilities is always opposite, right? Whatever we are doing. So in this case, again, we will see that your bills payable is increasing, and increase in current liability will lead to decrease in working capital. So I've written it in the decrease column. Sundry creditors have decreased. So decrease in current liability will lead to increase in working capital. Similarly for provision for tax also. Then what I need to do is I need to do the total of both the sides. When I do the total of both the sides, I can see my increase side is 3,14,000 and decrease side is 4,78,000. So that means my increase side is less and decrease is more. So this leads to decrease in working capital by 1,64,000. Now, my greater side is 4,78,000. So that means I need to make both the sides equal to 4,78,000. So as a result, the difference is put on the side which is less. That is 1,64,000, and the total comes out to 4,78,000. Now, in this case, I cannot calculate my funds from operation through a statement or through working capital account form. Reason being because there is no such item which I need to present it in the form of funds from operation. For funds from operation, only this item is there. So I can directly calculate the difference between the two, that is 17,64,000 minus 14,78,000. So rather than preparing a proper format for the funds from operation, it is better I can directly calculate it, right? So I have calculated it over here, 286. Whatever we have calculated over here, this is 286. This is your funds from operation. I will be presenting it directly over here. If we would have had more items, then we would have prepared a statement or an account, right? Then my capital is increasing by 2,50,000. So I can say it is increase in capital is a source for us. So we have shown it on the side of sources. At the same time, land and building is also increasing. So increase in land and building means I will have to make the payment. So that will lead to outflow of funds. So that is 3,50,000 under the outflow. Similarly, plant and machinery is also increasing and bank loan is decreasing. When I'm saying bank loan is decreasing, it means we have repaid the bank loan. And if we repay the bank loan, then certainly it will lead to application of funds. So when we do the total, then we get it as the balance is 1,64,000. So this balance is nothing but your change in working capital. So in this case, you have two methods. Either you show change in working capital as 1,64,000 over here, or you can show it on the sources side as decrease in working capital 1,64,000. So in that case, you would have got the total balance as 7 lakh, and here it will not be shown like this. So either way, either you show it below as your balancing figure, and which should be equal to your change in working capital, or you can show it over here. That's your choice, right? And if you want to present it in a form of an account, I've also shown it this way. Sources side, you have capital and P&L appropriation. That is, this is nothing but your funds from operation. And on the application side, you have land and building, plant and machinery, bank loan. So that means both the things are same. The only thing is presentation is different. And the balancing figure is 1,64,000. That is change in working capital. And if you want, you can show your change in working capital over here. That is 1,64,000. Then you need not calculate the balancing figure, and then your total will be 7 lakhs. Right? Now, there are certain items which need a clarification over here that is related to provision for tax. See, provision for tax it can be treated in two ways. Either you consider it as a current liability, like we had done in the question, and then you will be showing it in the schedule of changes in working capital, and that way it is finished. Nothing else to be done, right? Or what you can do is you can show the initial year figure. That means the previous year figure will be shown as application in your funds flow statement, right? And this is to be added to calculate funds from operation. Why do we say it this way? Because we say that by the time we pay the actual tax, it is in the next year. See, if you remember, or if you recollect your own tax that you pay, it is when we have to pay the tax for the year 2021, then we pay it in the year 21-22, the actual filing of the return. So same way, it says that whatever is the current year figure, I'm not going to pay it in the current year, that will be paid in the next year. So it will affect my funds availability in the next year. So I should add it right now. And the previous year tax will be paid in the current year. So I should show it as an application in the funds flow statement. But many a times what happens is this provision tax is to you in the liabilities as well as an additional information also. Like in this case, it is given in the balance sheet and it is given tax paid during the year is 10,000. So in this case, we need to prepare an account, and that account is prepared as a working note, right? Your 8,000 is the opening balance. This opening balance will be written over here because all the liabilities, they have a credit balance. So on the credit side, this closing balance will be written over here. Then they are saying tax paid during the year is 10,000. So you are paying the tax as 10,000. So when you do the total of both the sides, this side is less. So the balancing figure is written over here. That is the profit and loss account figure is this one. This is to be added to calculate FFO. And this is shown as application in FFS. Right? So the same treatment is also followed for proposed dividend. I'll show you how to do it in the question. From the following balance sheet of X Limited on 31st December 2019 and 20, you are required to prepare a schedule of changes in working capital and a funds flow statement. You can see a balance sheet is given to you. Now, apart from this balance sheet, some additional information is also given. That is depreciation charged on plant was 4,000 and on building also 4,000. Provision for tax is 19,000 was made during the year. An interim dividend of 18,000 was also paid during the year. So we need to prepare the schedule of changes in working capital. List down all the current liabilities, list down all the current liabilities. So we have written the balances over here. Increase in cash at bank. So in the increase column, increase in debtors, increase column, increase in bills receivable, increase column. Stock is decreasing, so in the decrease column. But for liabilities, we have opposite rule. Increase in liabilities, decrease in working capital. Here in this case, decrease in liability, increase in working capital. Accordingly, we'll do the total of both the sides. When we do the total, this side is less. And if this side is less, then okay, if this side is less, then it is net increase in working, because increase side is more. So it is increase in working capital. The difference is to be written over here, and then we do the total, right? Now, we have to prepare the working notes because many adjustments were given in the question. For plant is an asset account, right? And assets, they have a debit balance. So on the debit side, to balance brought down, on the credit side, by balance carried down. Right. Further, depreciation was given to us in the form of this, that is 4,000. So we calculate the balancing figure, and when we calculate the balancing figure, your balancing figure is coming on this side. So if this side is the balancing figure, then it is purchase. If your balancing figure comes on this side, then it is sale, depending upon which side your balancing figure is coming. Similarly, if I talk about the building, in case of building, your building is also an asset account, and asset, as I told you, they have a debit balance. So balance brought down, that is the opening balance over here, closing balance over here. Then we do the, okay, and thirdly, depreciation is given to us. This is also depreciation and this one also. Right? So in this case, it is 4,000. So when we do the total, now see, in this case, you got the balancing figure here. But in this case, you can see there is no balance because both the sides are tallying. So as such, no balancing figure. Next is the provision for tax. Provision for tax is a liability for you. So it will have a credit balance. So opening balance here on the credit side, closing balance here on the debit side. At the same time, we have been given provision for tax made during the year. It was not tax paid during the year. If it would have been paid, then this figure, but in the question, tax provision for tax made during the year, that means this figure is given, right? So when we do the total, we will calculate the balancing figure, and the balancing figure comes on this side, that is 17,000. This is the actual tax paid during the year, right? Now we need to calculate the funds from operation. This is the opening balance of your profit, and this is the closing balance of your profit, right? Then general reserve to be added, depreciation to be added, provision for tax. Under provision for tax, that was provision made during the year. Interim dividend. Now the question arises, there are two concepts over here. One is dividend and the other one is interim dividend. Interim dividend means an extra additional dividend declared by the company between two regular dividends. That means apart from the annual dividend, the company is giving an extra dividend to its shareholders. That is known as interim dividend. So that is also a part of your non-operating item. So that is to be added over here, right? Then we do the total of both the sides. We can see that this side is short. So on this side, our balancing figure is coming out as 46,000, which is known as funds from operation. Now for preparing the funds flow statement, now purchase of plant, that means application, increase in working capital, application, tax paid, application. Interim dividend, 18,000. All these are payments because all these transactions are involving payments. And purchase of investment, that means purchase of plant is increasing, tax paid, expense, interim dividend, expense, purchase of investment, that means your investment is increasing, but ultimately payment has to be made. So as a result, all these are applications. And on the sources side, you have funds from operation 46. So both the sides are equal. That means no further balancing figure, no calculation required, and both the sides will come on, will have the same balance. This is about your funds flow statement, right? Now, after this funds flow statement, let's move ahead with the next chapter, that is cash flow statement. Now, whenever we are talking about cash flow statement, that means it is a statement of flow of cash, and that flow could be inflow or outflow. When I'm saying inflow and outflow, that means I'm talking about the inflows and outflows of cash and cash equivalents. See, when I use the term cash, then it is certainly understood that is cash in hand or cash at bank, right? Because when we say cash, it is cash in hand and cash at bank. Both of them are considered as cash. But apart from that, there are certain other near substitutes of cash. Near substitutes of cash means those things which are readily converted into cash. They are considered as cash equivalents. right? What all is included under that, we'll be doing that in detail. And the overall activity in this case is also divided into three categories: operating and activities, investing activities, and financing activities. Now the question arises, why do we actually need to prepare this cash flow statement? Or basically, what is the usefulness of studying the cash flow information? It will help you to know the ability to generate adequate cash flows, right? Because until and unless you have adequate cash flows, your organization will not considered as an efficient organization. Because if you have a sufficient amount of cash flow, then it is a general tendency, or you can say it is a general mindset that it becomes a performance dimension for people, right? Because no matter, you might be having good amount of profits, but if you're not having sufficient amount of cash, people consider that, something is wrong, or maybe, they are not able to manage the operations. Next is whenever we are talking about cash flow information, it will clarify the dynamics of short-term liquidity and long-term solvency. Now, the question arises, what are these two terms? Sounding a bit different. So let's just try to understand. See, one term is known as solvency and the other one is known as liquidity. Both the terms are similar. The only difference is with respect to the time frame involved, right? First of all, whenever I'm talking about solvency, what does it means is, it means the ability of the business to repay its obligations as and when they become due. That means whenever your obligations become due, you have the ability to pay them, right? Now, if I study this particular thing on short-term basis, then it is known as liquidity. If I study the same thing on long-term basis, then that is known as solvency. So whenever I'm talking about solvency, we say solvency is for long term, right? Liquidity is for short term. Or you can say short-term liquidity is nothing but short-term solvency. So ultimately, both the things are exactly the same. Right? Now, at the same time, whenever we are talking about cash flow information, this information also is an essential input for the economic decision models whenever you need to take decisions in the organization, right? But at the same time, cash flow statement also has certain limitations. Like, for example, it fails to present the net income. Net income means profit. If you're not able to get the profit, then that means again you need to prepare the profit and loss account. Secondly, it fails to assess the liquidity and solvency position. Now, see, no matter in the usefulness, we have studied that it gives you information about the liquidity and solvency, right? But when we are talking about to assess the liquidity and solvency position, proper liquidity position cannot be assessed from your cash flow statement, because your cash flow statement is going to provide you the cash position at the end of the period. As I told you, it is not going to provide the continuous changes that are happening. It will only provide that, within the balance sheet dates. Okay, what is the situation today? But it is not going to tell that during the year what all happened. Similarly, it is not going to study your solvency position also on a continuous basis. And thirdly, we can say it's neither a substitute of funds flow statement nor income statement. That means even if you are preparing your cash flow statement, even then you have to prepare your funds flow statement, because funds flow is more broader in concept, and you also have to prepare your income statement, because income statement will tell you the profit earned or loss suffered. Then it will also not assess your profitability. Whatever profit you have calculated in your income statement, how to analyze it, how to interpret it, how to conclude it is not given by your cash flow statement. And it does not even show your financial position in totality. See, whenever I'm talking about your cash flow statement, do remember that cash flow statement is prepared as per AS3. AS3 means Accounting Standard 3. Right? Because in case of accounting, we have certain principles which are known as accounting principles, and we have accounting standards, which are the rules that have been shown with respect to how to deal with particular things. Right? So whenever I'm talking about this accounting standards, your cash flow statement is prepared according to AS3. So this AS3 does not depict the actual financial position of the business, and as a result, even the balance sheet is to be prepared no matter that you have prepared your cash flow statement. And lastly, we can also say that inter-industry comparison is also not possible. See, when I'm talking about inter-industry comparison, it means you cannot compare one company with another, right? Why? Because there might be a possibility that, your company is your company has made an investment of overall 10 lakh rupees and my company has made an investment of 20 lakhs, right? So and we are in the same industry, so even then we can't make a comparison between the cash flow statement of both the organizations, because when the capital invested is not same in both the companies, then we can't make a direct comparison between the two. There are certain, just a minute. Okay, so there are certain terms that we talk about under your cash flow statements. With respect to cash flow statement, cash flows and cash we have already done. And now if I talk about the cash equivalents, I told you that whenever we are talking about cash equivalents, that means we are talking about the near substitutes of cash, which will be immediately be converted into cash as and when there is a requirement. Then we have three different activities based on which we divide the overall cash flow statement into three segments. That is operating activities, which is the principal revenue producing activity, or you can say the core business activity of the business related to your organization. Second is activities. Investing activities means in which all assets you have. When I'm talking about assets, that means I'm talking about long-term assets. In what all long-term assets you have invested your funds, and the disposal of those, sorry, not funds, the assets. In which all long-term assets you have invested your funds, and in which all long-term assets you have remove your investment, or you can say you have disposed them of. Next is your financing activities. Financing activities means we are talking about the change in size and composition of the capital invested in the business, right? And there are certain extraordinary activities. When I'm talking about extraordinary activities, that means I'm talking about the events which are not done or which do not happen in the normal ordinary course of business. That means they are the abnormal activities happening in the business, right? Now, these are the certain examples given to you with respect to your operating, investing, and financing activities. As I told you, operating activity means your core business activities. So if you are getting cash receipts in the form of, maybe say, you can say cash sales and all, so that is your inflow of cash from your operating activity. But when you have to pay the amount for the purchase of raw material, that becomes an outflow of cash under your operating activity, because buying the raw material and selling the finished product, they are the core activities, core business related activities of your organization. Now, if I study the same thing with respect to your investing activities, in investing activities, you have, if I am buying long-term assets, maybe I'm buying property or plant or equipment, right? So all these will be a part of, if I'm buying it, that means I'm using my cash. I'll have to make the payment. So as a result, it will lead to application, or you can say outflow of cash. But if I'm selling all these things, that means I want to sell a property, I want to sell the plant or equipment. And if suppose I have investments and I want to liquidate my investments, so as a result, that will result in inflow of cash. And if I talk about financing activities, that means if suppose I'm issuing more equity shares, issuing more equity shares will result in more amount. No doubt it is increasing liability, but at the same time, it will also increase my cash. So that will result in inflow of cash. Similarly, if I'm issuing debentures, if I'm raising loan, all these things are going to increase my liability and at the same time increase the availability of cash. But if I want to repay them, that means if I want to repay the loan, if I want to repay the debentures, or if I'm paying dividend, if I'm paying interest, so all these activities will be counted as outflow of cash under the financing activities, right? So whenever we are talking about the preparation of your cash flow statement, this statement is categorized into 4 steps, starting with the cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. Then you add these 3, that is operating, investing, and financing activity. And to this, you add the opening balance of cash and cash equivalents. Whatever is the result that you will get should be equal to your closing balance of cash and cash equivalents. And do remember, you cannot change the sequence. Operating, investing, financing, you cannot change the sequence. You cannot bring investing to number 1, financing to number 2, operating to number 3. No, it has to be OIF, right? Now, these are the examples I have given with respect to the different activities. If I'm talking about operating activities, that is the core business activity, then your inflow can be in the form of cash sales, cash received from debtors, commission and fees received, or royalty received. And your cash outflow could be in the form of cash purchases, payment to creditors, cash operating expenses, payment of wages, tax, manufacturing expenses. Similarly, under investing activities, you have all the sale of your long-term assets and all the income that you generate from such long-term assets, maybe in the form of interest received, dividend received, rent received, anything that will be a part of inflow. And if we talk about the outflow, then the reverse will happen. That is purchase of fixed assets and purchase of investments. That means if we are buying long-term assets. Then if I talk about the financing activities, if you are raising long-term liabilities, that means issue of shares, issue of debentures, long-term loans. So they all will be counted under inflows, and outflow means repayment, or if you are paying your dividends or the interest, then that is also counted as outflow of cash under financing activity. Now, when we have to prepare the cash flow statement, there are 2 methods of preparing the cash flow statement. One is known as the direct method and the other one is known as the indirect method. In case of direct method, the net cash flow from operating activities is calculated by receipts that are collected from customers, cash paid to suppliers or employees, and interest or income tax paid. That means the actual figures that have been paid or received are taken into account without making any adjustments related to non-cash and non-operating items. That is your direct method. And indirect method is when you consider even the non-cash and non-operating items into consideration. But when we talk about the Companies Act will give or Companies Act gives recognition only to the indirect method. The organizations, they followed the indirect method, right? As I told you, the direct method will not take into account your non-cash and non-operating items like your depreciation, amortization of intangible assets. So as a result, no adjustment is required with respect to the non-cash items. You can just have a look. If you are calculating your cash flow statement with the direct method, so the only difference is only in the operating activities. Investing and finances are exactly the same. So in this case, you will consider the cash receipts from customers, cash paid to suppliers and employees, cash generated from operations, minus the income tax paid. And if in case you have any extraordinary items that are to be considered, and finally you calculate the net cash from operating activities, right? Right. Now, the question arises that we are considering certain extraordinary items. So let's just try to understand what exactly these extraordinary items mean. See, extraordinary items basically means these are not the normal activities of the business. They do not, they are not recurring activities. They are not the normal activities which are expected to be repeated again and again. So as I told you that there are three types of activities over here: operating, investing, and financing. Operating activity means when I'm talking about the core business related activities. So paying salary is a core business transaction, right? But if I say that, your organization has announced a voluntary retirement scheme, that is VRS. So that means you will have to pay compensation to the employees who opt for the VRS. So that is also an operating activity, but that is considered as an extraordinary activity under operating activities. Now, if I talk about investing activities, suppose there was a fire in your organization, because of which the fixed assets, like say, for example, your building has damaged, right? And now you are, first of all, that loss is an extraordinary item. It is not a normal activity. Secondly, whatever claim you will be receiving from the insurance company, that claim will also be a part of your extraordinary item under investing activity. Next is financing activity. Now see, when I'm talking about debentures, we have to repay them. When I'm talking about loan, we have to repay it. But if I talk about equity shares can never be repaid during the lifetime of the company. But yes, if the company decides and if they think that, too many equity shares are floating in the market, and in that case, if they want to take a decision, what they can do is they cannot repay those equity shares. What they can do is they can buy those equity shares from the market. That means they can just give an option to the shareholders that they are, they are going to buy it as buyback of equity shares. So this buyback of equity shares is also not a normal activity, and companies, they do not do it regularly. So that is also a part of your extraordinary item under financing activity. Now, if we talk about the cash flow from operating activity as per the indirect method. Under indirect method, this is your format. As I told you, you have to make adjustments related to non-cash and non-operating items, like we did in funds flow statement also, right? Once this part is done, after that, see, we basically start with net income before tax and extraordinary items. To this, we add all the non-operating and non-cash expenses and losses. Then we can get the funds from operation, right? You remember in the previous chapter, we had calculated the funds from operation. To this, we make adjustments related to current assets and current liabilities. That means working capital components. And when we are making changes with respect to working capital components, then they say, here the rules are opposite. Why? Because we are not studying just working capital. Here we are studying the cash availability, right? So if in case your current assets are increasing, if your current assets are increasing, see, in case of current assets, we are excluding your cash and cash equivalents over here. Cash and cash equivalents are considered at the last, right? So apart from cash and cash equivalents, what all current assets and current liabilities you have, they are to be studied over here. So in this case, the rule is opposite. If your current asset is increasing, if your current asset is decreasing, your cash is increasing. And for liabilities, the rule is opposite. If your current liability is increasing, your cash is increasing. If your current liability is decreasing, your cash is decreasing, because you are repaying that current liability. And if you are repaying the liability, then certainly your cash is moving out. We can say it is an outflow of cash, right? Now, this is the format for your cash flow statement as per the indirect method. As I told you, we start with net profit before tax and extraordinary items. This tax and extraordinary item, net profit before tax and extraordinary item is shown as a working note over here. You have a choice whether you want to show it as a working note or you want to present it in the main cash flow statement. That means we take the difference of your closing and opening balance of the profit and loss account, and to this add all the reserves. Reserves means a part of profit which is retained in the business, right? Then dividend. Why do we add the dividend over here? Because dividend is not your core business activity. Interim dividend, provision for tax, extraordinary items which have been debited in the P&L account. Less extraordinary items if any item was credited in the P&L account, and then we calculate the net profit before tax and extraordinary items, right? Now, after this, we get this A part. To this, we add all the non-cash and non-operating expenses and losses. We subtract all the non-cash and non-operating gains and incomes. Then we get operating profit before working capital changes, to which we add all the decrease in current liabilities and increase in current liabilities. As I told you, current liabilities and assets, they move in the opposite direction. And we subtract increase in current assets and decrease in current liabilities, right? Now, then we get cash generated from operations. Once you get your cash generated from operations, you have to subtract the tax that you have paid during the year. And finally, you get your, and if in case extraordinary items are given, then that is also to be shown over here, plus or minus, depending upon whether it is a loss or gain. But do remember that extraordinary items are not given always. No matter, rarely they are given, but yes, they can be given, right? So then you get cash flow from operating activities. This is the first part of your cash flow statement. Then we move ahead with the cash flow from investing activities. Under investing activities, as I told you, we consider the long-term assets. That means purchase and disposal of long-term assets and any income generated from them, right? So if in case we have proceeds from sale of fixed assets, so that means I'm selling my fixed assets, so I will be getting some cash. So that will be an inflow of cash, right? So that will be a plus figure. Similarly, if I have any other asset that has been sold, which is going to increase my cash availability, that will also be there, right? Then next is your any income received from such assets. As I gave you the example that if in case I have an extra building which is lying idle, so what do? Is I give it on rent. So whatever income I'm generating from the investing activity, that will also be a part of my investing activity. Say for example, I have idle cash lying in my business, right? So if I have idle cash in my business, what I can do is I can make an investment. If I'm making an investment, that is an outflow of fund. Why? Because when I'm making an investment, say for example, I'm buying the shares of some other company, right? So I have to make that payment. So accordingly, that will be an outflow. But when I get dividend on that investment, or if I get some interest on my investment, then that interest and dividend will also be shown over here as a part of investing activity, because the income that we get out of the investing activity is also a part of investing activity, right? So generally this item is a negative figure. Why it is a negative figure? Because it is cash flow from investing activities, right? Because in this case, when I'm saying it is a negative figure, see, I'm using the term usually. I'm not saying it is always a negative. It is usually negative because at any point of time, if I have a running business and my business is, moving in a normal way, there are no problems in my business, then in that case, it will be like more assets will be purchased than it will be sold, right? See, I'm not saying that it can never be a possibility that it can have a positive answer, because there might be a possibility that, I'm going to sell my one of the extra buildings I have, and that building has a huge amount involved. So in that case, I can get a positive figure also. But usually what we have seen over the years is that the amount of assets purchased is more as compared to the amount that we get by selling them off. So usually this is a negative figure. Next is your cash flow from financing activity. This is related to the size and composition of your long-term capital. When I'm saying capital, that means I'm talking about equity as well as debt, right? So in this case, if the company is issuing shares, if the company is issuing debentures, if the company is raising long-term loan, right? So all these will be considered as your inflow of cash, because no matter, liability is also increasing, because if I am raising a loan, that means if bank is granting a loan to me, then certainly my liability is increasing. But at the same time, for the present, I mean, if I consider the present situation, then in that case, my cash is increasing. I'm showing that my liability is increasing, but at the same time, my cash is also increasing. But with respect to that cash, with respect to that liability, I have to pay a cost, maybe in the form of, you can say, in the form of interest, in the form of dividend, like if I have issued more shares. So whatever is the cost that I have to pay, that is considered as an outflow of cash under financing activity. If I'm raising more capital, then it is a you can say it is an inflow of cash. But if I am repaying, say for example, I'm redeeming debentures. Redeeming means I'm repaying the debentures, I'm repaying the preference shares, or maybe I'm repaying the loans, right? So in that, all these things, it will be considered as outflow of cash, and all of them will be shown as a negative figure. So after that, I will be calculating the final amount of cash flow from financing activities. See, under all three activities, operating, investing, and financing, if the figure is positive, then we call it as cash flow from operating activity, investing activity, financing activity, whatever may be the situation. But if the figure is negative, then we write it as cash lost in or cash used in operating activity, investing activity, or financing activity, right? So if positive figure, then cash flow from, and if negative figure, then cash used in, right? Now, once these three activities are done, then I need to calculate the total of all three. That means I need to sum up all the total of all three activities, right? When I add them all, I need to see whether the overall answer is a positive figure or a negative figure. If my overall answer is a positive figure, then it is known as net increase. But if my overall answer is a negative figure, then it is known as net decrease in cash and cash equivalents, right? Now, this is the final amount I am left with. Now to this, I need to add the opening balance of cash and cash equivalents. Now, you can just have a look. Cash means cash in hand and cash at bank. And your cash equivalent means short-term deposits, current investments, marketable securities. And if I'm talking about these three, that means the time period involved in these three is up to 3 months, right? So up to 3 months, if your time period is there and you have marketable securities, current investments, or short-term deposits, then they are considered as a part of cash equivalents. Otherwise, they will not be considered over here. And if such investments or securities are there, then they will be considered in investing activity, right? If it is for more than 3 months. So to this net increase or decrease in cash and cash equivalents, I will add the opening balance of all these. There might be a possibility that you might not have all these in your question. You might have just the first two, or you might have, the first two and any one of them. So depending upon the situation, whatever balances are given, you will add them all. And when you add it, the result that you will get should be equal to the closing balance of all these. When you add the opening balance of all these to the net increase or decrease, your result should be equal to the closing balance of all these, right? This is how we prepare the cash flow statement. You have a question related to it? Prepare a cash flow statement on the basis of the information given in the balance sheet of Simco Limited as at 31st March 2019. Now, you can see this balance sheet is presented in a different way. Why? Because this balance sheet is prepared as per Companies Act 2013. This is how the companies prepare the balance sheets. You can see the note numbers are given. Although I've explained this sheet in the previous class, but still these note numbers are given and the explanation related to these note numbers are presented over here in notes to accounts. And there is also an additional information. Proposed dividend for the year ended 31st March 2018 and 19 were 10,000 and 8,000 respectively. Provision for tax made is 9,400. Fixed assets costing 20,000, accumulated depreciation till date of sale 6,000 was sold for 10,000, and new debentures were issued on 31st March 2019. Right now, if you have to prepare the balance, your cash flow statement in this case, first of all, let's prepare the working notes first. The treatment of your provision for tax is same what we did under funds flow statement, so that will not be changed, and we'll move ahead in the same direction. Now, first of all, we need to calculate net profit before tax and extraordinary items. See, when we did the format, I had tried to give you all the items. So as such, you could see that, the format was a very long format, but certainly when you get the questions, your questions are not that long, right? I mean, you will not have so many items, but yes, I have tried so that at least you should be aware of the items that can be shown under each head, right? So I start with the difference between the closing and the opening balance, that is 400. And there is also a transfer to general reserve, right? That general reserve is to be added over here. Then proposed dividend. As far as your proposed dividend is concerned, it says that the previous year figure is to be paid in the current year. So that is only to be added and shown both, right? As paid and to be the one to be added to the net profit to calculate your net profit before tax and extraordinary items. So that means the current year figure is not to be considered. Then is your provision for tax. You need to prepare the provision for tax account. As I told you, provision for tax is a liability. So opening balance on the credit side, closing on the debit side. Then what they have given is the provision for tax made during the year is 9,400. Then we do the total and we find that tax paid during the year is 7,000, which is your balancing figure. But the figure that we need to add to calculate your net profit before tax and extraordinary item is this one, 9,400. So we add this and the overall answer we get is 23,400, right? Now, to this, we need to add all the non-cash and non-operating expenses and losses. For that matter, we'll have to prepare the fixed assets account and accumulated depreciation account as the information is given to us in the question. Fixed assets are your asset account. So they have the debit balance. So on the debit side, we'll write the opening balance. On the credit side, the closing balance, right? They are further giving that there is a particular fixed asset that you have to sell, right? And what they're saying is that you have sold it at a value of 10,000, on which there was an accumulated depreciation of 6,000. I'll show you the question once again so that it will be more clear. Now just have a look. Fixed assets costing 20,000. So that makes it to 20,000 less depreciation 6,000. The book value comes out to 14,000, right? And 14,000 is the value of the asset, but you have sold it for 10,000. So that means there is a loss. Your book value was more and you have sold it at a lesser price. So as such, there is a loss on sale. So you have sold it for 10,000. Accumulated depreciation was 6,000 and loss on sale was 4,000, right? Then we do the total of both the sides and balancing figure comes out to be 18,000 on the debit side. When it is on the debit side, it means purchases. And in the accumulated depreciation, or it is known as the provision for depreciation, it will have a credit balance. So on the credit side and closing balance on the debit side. Now there is a transfer of you can just have a look. The amount that is to be transferred to the asset account. Right? So in this case, you can see it was this 6,000 that was transferred on this side, right? So as a result, when we do the total of both the sides, we can see that the balancing figure is coming out to be 14,000. And this is the amount that will be added under the operating activities, right? Now we move ahead with the exact statement. As I told you that to this net profit, we need to add all the non-cash and non-operating items, right? So under the non-cash expenses, we have depreciation, which we have just calculated, 14,000. Then interest on debentures. Debentures given to us are, just have a look. These are the debentures and it is 15% is the value, right? And they are saying that new debentures were issued on 31st March 2019. That means on the last day. So if they are issued on the last day, that very day only, I'm not going to give them any interest. So that means they will be getting the interest in the next year. So in the present year, the interest will be given to these many debentures only. That is 12,000. So 15% of 12,000 will be 1,800. Then there was a loss on sale of fixed asset that is also to be added. Then we get operating profit before working capital changes. And when then we also need to make certain changes related to your current assets and current liabilities. Under your current assets and current liabilities, there is a decrease in trade payables. Trade payable is your liability. Decrease in liability means you have made the payment. And when you have made the payment, your cash is decreasing. So I have shown it as a negative figure. Then your inventory is increasing. If I've purchased more inventory, then again I've made the payment. So as a result, a negative figure because it is reducing my cash. Then there is a increase in trade receivables. So that means that is again blocking my cash. So again a negative figure, and increase in prepaid expenses also a negative figure. This will give me cash generated from operating activities before tax, and then I subtract the tax paid during the year, and finally I get the positive figure, that is 2,400. So I'll show it as cash flow. I'll not write cash used in, I'll write cash flow because it is the positive answer, right? Next, I move ahead with the cash flow from investing activities. In case of investing activities, we just prepared the fixed assets account in which the balancing figure was purchase of fixed assets. So I'll show the and purchase of fixed asset means outflow of cash. So as a result, negative figure. But at the same time, there was also a transaction related to sale of fixed assets. So that will be shown as a positive figure. So the overall answer is a negative figure because 18,000 is the minus figure and 10,000 is the positive figure. So overall answer is negative. And when this is negative, so I will show it as cash used in investing activities. Now, in this case, I will not write cash flow, I'll write cash used. Next, we have cash flow from financing activities. Under financing activities, my equity share capital is increasing. That means we have issued more capital, more equity shares, that will increase my cash availability, so positive. But preference shares are decreasing. That means we have repaid, we have redeemed. That means it is a redemption of preference shares. So as a result, negative figure. Then debentures have been issued. More debentures are there. So as a result, a positive figure. But whatever interest we have paid on debentures is certainly an outflow of cash. So that will be a negative figure. And the dividend, the final dividend that has been paid during the year, is again a negative figure. Reason being because that is outflow of cash. So if I add all these, my final answer comes out to 10,200. That is again cash flow from financing activities because it is a positive figure. Now I need to add all these three items: operating, investing, and financing. So when I add these three, I get a positive figure of 4,600. Just because it is positive, I'll write net increase. If it would have been a negative figure, I would have written net decrease, but now it is net increase in cash and cash equivalents. To this, I'll add the opening balance of cash and cash equivalents. That is 2,400. And the result that I get is the equal to closing balance of cash and cash equivalents, which you can check with your balance sheet, right? I have taken one more example related to your cash flow statement. Following is the balance sheet of Mivanka Limited as at 31st March 2017. Again, a balance sheet is given to you and the related notes to accounts are also given. And apart from that, they have also given additional information in the form of additional loan was taken on 1st July 2016 and tax of 53,000 was paid during the year. Right now, before I move ahead with the statement, let's just prepare the working notes. Now, in this case, I have to prepare the provision for tax because information is given related to tax in the additional information. Right? Provision for tax is a liability, so it will be having a credit balance. So opening balance on the credit side and closing balance on the debit side. Right? Now, once this is done, then what is given to us in the question, that is tax of 53,000 was paid during the year. Now, in this case, they are not showing you the P&L figure. They are showing you the figure that has been paid. So that means now in this case, this is given to you. That is the amount of tax paid during the year. So when you will have to calculate the balancing figure, you will do the total. And when you will do the total, then you will see that your balancing figure comes on this side. And this is the amount that is to be shown in your statement of P&L in the form of provision for tax made during the year. Right? So this is 51,000. Now starting with the actual statement. See, in this case, what I have done is I have shown even the calculation of net profit before tax and extraordinary items in the statement itself. So it's your choice how you want to present it, right? So my net profit for the year is closing balance, that is 25,000 minus the opening, that is 1,20,000. So I'm getting a negative answer. Otherwise, it is normally closing minus opening, which is a positive answer if my current year profit is more as compared to my previous year profit. Right? But in this case, it is the reverse situation because there can be, I'm not saying that I'm suffering a loss in this case. It only means that the current year profit is less as compared to the previous year, right? So my overall answer in this case is a negative figure. To this, I will add the provision for tax that I've just calculated, 51,000, and I get my net profit before tax and extraordinary items as minus 44,000. To this, I need to add all the non-cash and non-operating expenses in which I have interest on long-term loan, that is 7,500, and depreciation for the year 25,000. Right? So as a result, my total non-cash items are 32,500. And when I do the total, you can see 44,000 minus 32,500 plus. So my net answer is 11,500 minus. right? Now I have to consider my working capital changes, right? Under the working capital changes, I have other current assets that are decreasing, so I will add them. My trade receivables are decreasing, so I have added them. At the same time, my trade payables are decreasing. That means decrease in current liability will lead to decrease in cash because I have repaid it. So here it will be 14,000. Similarly, inventories are increasing. So that means I have purchased more inventory. So as a result, my cash is decreasing. So this is again a minus figure. I add these two and the answer is minus 21,000. So the net answer I'm getting till now is 14,500, right? Then I need to minus the tax paid. The tax paid, the previous year taxes paid in the current year. So I have written over here 53,000. So the net answer that I will be getting over here is 67,500. And this 67,500 is the cash used in operating activities. Now you can see I have used the term used. Reason being because I'm getting the answer as a negative figure, right? Next, I move on to cash flow from investing activities, under which I have just one component given to us, that is purchase of plant and machinery. And if I'm purchasing, that certainly is a outflow of cash. So that is minus 1,69,000. So this is again a negative figure. So I'll write cash used in investing activities. As far as your financing activities are concerned, you have issued the shares because your share capital is increasing. So it is a positive figure because it is increasing your cash. Then you even the long-term loan is increasing. That means you have taken more loans. So that is 20,000. But at the same time, the interest that you pay on loan. Now, how to calculate the interest on loan? See, interest on loan, if I just show you the question again. Yeah, you have 10% long-term loan and the amount was 80,000 in the 60,000 in the previous year, 80,000 in the current year. And what they are saying is additional loan was taken on 1st July 2016, right? So in this case, that means the loan was taken on 1st July. So let's see how to calculate the interest. But before this 1st July 2016, I have initial loan of 60,000. So 10% of 60,000, and this loan was for April, May, and June. That means for 3 months. So 3 by 12. Plus 10% of, you have taken additional loan. So now your new loan amount is, total loan amount is 80,000. And this 80,000 was there for 9 months. That means starting from 1st July till 31st March, right? So that means 10% of 60,000 into 3 by 12, that is 1,500. And 10% of 80,000 for 9 by 12, that is 6,000. So my total interest on loan comes out to 7,500, right? So that 7,500 is an outflow of cash. So I have shown it over here as outflow. That is a negative figure. I again add all these three. I get the final amount as 2,12,500. Now my operating activity was a negative figure. So it was cash used in operating activity. My investing activity was a negative figure. So it was cash used in investing activity. But my financing activity is a positive figure. So I'll write it as cash flow from financing activities. Now, finally, I have calculated all the three activities. I will be adding them. And when I add them, I get net decrease. Why? Because the overall answer I'm getting is a negative figure. So I'll write it as net decrease in cash and cash equivalents, right? To this, I will add the opening balance of cash and cash equivalents, which is equal to 49,000. You can just have a look. My cash and cash equivalents are given to me 25,000 for the current year and 49,000 for the previous year. So that means my opening is 49,000. So I'll just add it over here, 49,000 added. The result, see, 24,000 is a negative figure. 49,000 is a positive figure. So the overall answer that I'll be getting is 25,000, which is a positive figure. And this 25,000 is equal to the closing balance of cash, that is 25,000. So that means we do not get any balancing figure. Whatever is the answer that we get, under your cash flow statement, that particular figure is known as your closing balance of cash and cash equivalents. That's it, right? This is how we prepare the cash flow statement. So with this, we come to the end of your cash flow statement as well. Any doubts?
Ma'am, no doubt.
Okay,